right, so let's begin this very special segment today. And when it comes to money, confidence is everything. But confidence doesn't come from luck, it comes from knowledge. In today's fast-changing financial world, where every day brings new products, new platforms, and endless advices, how can investors truly feel empowered to make the right choices? Are Indian investors becoming more confident, or are we still following what we hear on social media and WhatsApp groups? And what does it really take to move from being a hesitant saver to a confident investor? To discuss all of this and more, joining me today is Ankur Thakore, Chief Business Officer at HSBC Mutual Fund, who will help us decode what financial confidence really means and how investors can take charge of their money with clarity and conviction. Hi, evening, and welcome to the show. Let me put this first question. What does it really mean to be a confident investor in today's financial markets with so much of noise around it as well?
Yeah, thank you very much. Good evening. To me, a confident investor is one who definitely knows what their financial goals are. They've already built a plan, but this more importantly stick to the plan despite all volatility and the noise which will be there in the market. Because the most important part for a person to achieve their financial goal would be to stay put on their plan, irrespective of what's happening and the noise around in the market. So I would think that's the most important part in terms of a confident investor.
Very interesting. But then, do you think Indian investors are becoming more empowered, or is there still a trust gap? We hear stories about tier 2 and tier 3 really participating and taking away the big chunk of investments also. But then, how much do you think is based on the right approach of investment, or do you think it's just investor interest that's big, we are seeing, but it still lacks financial literacy? Are they truly empowered, or you think there is still a trust gap?
Truly speaking, the number of customers coming through have increased, but I would still say there is still a big gap in terms of financial expertise or financial literacy, which is needed to be built in. And that is what is leading to some bit of a trust gap because many a times people tend to invest without actually having the reason why they are wanting to invest in. And when that is the situation, you are kind of just investing for the sake of what you've heard in the market or what you've read on the WhatsApp or so on and so forth. I think the empowerment will come through once we are able to build more financial literacy, when people are able to understand why they are doing a kind of investment which they are doing today. And that is something which will shift from being just a normal investor who's doing for the sake of hearing or doing things basis what they've heard, but actually getting into a proper investment plan would be the shift which I would expect over the course of next few years.
All right, Ankur, now what according to you are first three steps an investor should take before putting money into any product? And I'm talking about someone who's a new investor who's just heard about equity and because of the noise has also felt attracted, or the FOMO that we usually talk about. So what according to you would be the right step, and what kind of a homework you would recommend an investor also to do, at their end?
Sure, I think that's a very important point because most of the time people end up talking about products and the vehicle as the first step. That actually is the last step in terms of where we should be going in from an investment perspective. The first step, in our opinion, would be that we first need to identify ourselves. Why are we saving? Which means what are our financial goals? Why we need to save? The second step is to understand ourselves. Many times people tend to either overestimate the risk taking capability or underestimating their risk taking capability. First, we need to understand where do we stand on a risk matrix. Basis these two will define the kind of products we would like to choose, and hence comes to the asset allocation part. So this may sound very complex, but it is first understanding ourselves, where we stand, what we want to do, and basis that kind of come to the products and the kind of schemes which we would be wanting to invest in. So three-step process: identify your goals. Two is to understand your risk profile, and then basis that risk profile and the return expectation from those products, you come to an asset allocation plan.
Very interesting. And once you identify your goals and you know the investment horizon, because Ankur, a lot of time the goals are short term, medium term, and long term, and that is when the investment alternatives or the choices also differ depending on the investment duration. So that's a very important tip from you. But then, let's also talk about all the noise on social media. People still follow a lot of groups on social media, hearsay and WhatsApp forwards. There is a WhatsApp university on its own. How can they shift towards informed choices, and who should they trust? I mean, knowing what's your risk appetite, knowing what's the kind of investment or investment avenue comfort you have, people get swayed with a lot of other advices and free advices which are going on. So how can one really stay informed and make informed choices, more importantly?
I think we should first accept the fact that whatever is free is not necessarily best for us.
Definitely.
And
Sure. Yeah.
hence, while we are talking about making the right choices, I think it's very important to first work on finding out who's the right financial advisor, or should I say financial expert, whom I should be working with. Because many a times we kind of get drifted with all the noise which is there in the market, and that can cause a lot of upheaval in our minds or our investment plan. So the way a person should look at is first try and identify what they are wanting to achieve, which we already spoke about. But then, as a next step, try and find somebody whom they can trust, whom they believe in, and who can guide them through this whole journey and make a good investment plan. Because at the end of the day, what is going to come as an outcome is going to be what you plan today for the outcome which is in future, which is in near term future or far off in future. But unless we have a plan why we are making that investment, we will not be able to achieve what we are actually wanting to do in our life. So,
Sure.
finding and putting an effort to find a financial expert or an advisor whom we trust in most cases is actually the most important part of our whole investment journey.
Absolutely. Also, new investors usually don't understand a lot of things that goes on behind recommending a fund or maybe a strategy, transparency, which an investor should expect, and even the regulator and, AMCs like you are also working towards it. So I want to understand from an investor's perspective, what transparency or disclosure should investors demand from their advisors or service providers? There has to be a back check. How can one do it?
I think a very important part, and just to talk about from where I was talking about as a first step earlier, where we need to talk about a financial advisor, who should be a financial advisor or a financial expert. I think there are two areas which I think we definitely need to look at while we are choosing a financial advisor. The first step, I think, is to understand the credentials this individual or an organization brings to you. Not all organizations are working in a similar manner or for the same outcome. Each one has their own strengths, but understanding the credentials is the first step for us. And second is the area which is their expertise or experience of this organization or an individual. Because when we put these two together, it will then kind of put in place what is it that we are expecting from that individual or an organization, and what is our outcome which is being looked at. I think credentials and expertise are the two big areas which each one should demand or look into from their financial expert or the financial advisors whom they are dipping into. If we are able to get these two answers from them, I think we are kind of starting on a good footing.
All right. One should really remember that as you have a family doctor, in the same way, you should be having a financial advisor also. And they are just not there to recommend a financial strategy. They are there to handhold you in your entire life and the financial responsibility that you think a financial advisor should be having on them, on your behalf. It's very important for you to work closely with them and also figure out whom you can trust with your money. So, yes, just by seeing good returns or, if the recommendation really works for you, that's just not the role of an advisor. One has to really go deeper and take them as their mentor as far as their financial life is concerned. So yes, very tricky for a few people who are new to the markets, but at the same time, very important selection for a role that investors should keep in mind. But let's also talk about Ankur, digital platforms and fintech apps. We're also looking at robo financial planning that's in trend these days, looking at AI and the way they are guiding investors. Do you think digital platforms and fintechs are genuinely empowering consumers or adding new layers of confusion, especially with respect to trust and investment choices when the investor is not very much well aware and well versed with the avenues right for them?
No, you very rightly put it across. Digital platform brings amount huge amount of convenience for people who definitely know what they want to do. The challenge for us is that most customers don't know what they want to do or what they need to do. I think so. Digital platform does have a convenience for DIY customers who are actually very well informed, very well equipped on whatever they need to do from an investment perspective. But as a reality, most customers really don't know why they are investing. And I think that's where the human touch needs to come in. Robo advisory surely does add value in terms of having to kind of segregate a certain segment of customers and put that as a plan for the broad behavioral pattern which a customer would have. But when it comes to one is to one, no two individuals are similar. We are as human beings are very emotional. And in that journey, while we are trying to build a plan, to sticking to the plan is where the most critical part of the human touch comes into play. If I have to say, investors are technically their worst enemies because we ourselves kind of either panic or get too bullish in scenarios basis the what's the market environment. And that can hurt us because in a very bullish scenario, you end up making too much of allocation towards very aggressive products. And in a volatile market, kind of stay away from those kind of asset classes, which can hurt us. So robo advisory, do it yourself kind of platforms does add value for an absolutely informed and a confident investor. But when it comes to most set of investors, we need the human touch to actually help us out to stick to our plan.
All right, very important takeaway. But with that, it's the end of this particular segment also. Thank you so much, Ankur, for joining in and for hand-holding our investors and empowering them, or at least giving them the first right step trick towards their financial life. Thank you so much for joining in today. And with that, it's time for a short break on The Money Show, but then we'll be right back with your portfolio queries answers with our financial planner.